Hey everyone, welcome to the mock for COM 221. So the format of your exam, for those of you that didn't take any of the other mocks, should be the same as this one. So 20 multiple choice questions and 3 long answer covering the entire course. The first question here, it tells us, Barry has a utility function given by this u. Now normally we saw it written as the something w or y. So if I say u equals w to the power 0.6 or u equals income to the 0.6, same thing. That's his annual income, and it says he has a current job that pays him $80,000 per year and has a 25% chance of a bonus of $15,000. What would be the salary of a job with no bonus that he would find equally as appealing? What does equally as appealing mean? It means it would give him the same level of utility. So the first thing that you can do, this is a CEQ question. So step number 1, always in CEQ you find the expected utility, EU, by taking the probability. So if he has a 25% chance of getting a bonus, that means he has a 75% chance of not getting a bonus. And this I find by doing 1 minus 0.25, because the probabilities have to add up to 1. So 75%, and if he doesn't get a bonus, then what's his income? His income would be 80,000, or his wealth would be 80,000, because here he's only got income, there's no other investment, so that is his wealth, to the power of 0.6. Plus, so I'm just taking the 80,000 and plugging it in here as his income to get how much utility, how much happiness does he get. And if he does get the bonus, that's a 25% chance, then what would be his income? Then his income would be 95,000. How did I get that 95,000? I did 80,000 plus the bonus. So 80,000 plus the 15,000. That means his total income would be 95,000 at that point, or his wealth. And now first let's get that expected utility. So I can just plug it in my calculator in one shot. This would give me an expected utility of 898.44. Is that my answer? No, that's his expected utility, his expected happiness from this job with the bonus. Now, what job would give him the same level of satisfaction, or that he would find equally appealing? If it doesn't have a bonus, that means 100% he's getting a certain wealth. So in step 2, I can go back here into this equation and plug in the u now as 898. Whatever was his happiness from the job with the bonus, let's say that's the same as his happiness with the second job. But in the second job, there's no bonus, so it's 100% that he makes W, or he makes, you could put a INC for income here as well, same thing. W is just easier to write. So now if I solve for W, I would bring the 0.6 to the other side, and whenever you bring the exponent to the other side, it becomes the power of 1 over that exponent, so it'd be to the power of 1 over 0.6, or you could do 0.6 root of 898, same thing. So whenever you bring the exponent to the other side, it becomes the power of 1 over. You could plug that in your calculator in one shot, just make sure you use brackets. So it's 898, or I'll just keep the answer in my calculator so that there's no rounding, to the power of, open brackets, 1 over 0.6, close brackets, and this would give me 83,653.12. And that's it, that's your answer. So that's C. That is called the CEQ, the certainty equivalent. The certainty equivalent means the level of certain income or certain wealth that will give him the same utility as the gamble. The gamble was with the bonus, because then there's probabilities. He has 75% chance of not getting it, 25% chance of getting it. And often in the CEQ, there is a third step as well. Like the third step, normally if like they're asking you about a lottery or something, then step number 3 would be like if they say, like how much would he be willing to sell the lottery ticket for? In this case, for a job, it doesn't make sense. You can't really sell a job, but you would have normally taken the difference between your step 2 number, like 83,653.12, minus his original income, which was 80,000. And that would give you like 36.53. That would be how much he's willing to sell the lottery ticket for if there's like a difference, or that's how much extra you would have to pay him. You know, if they, for example, in this question, if they had told you, how much extra would the new job have to pay him if there's no bonus for him to be equally as appealing? So the old job was the first line, 80,000 a year, 25% chance of bonus. Now if they tell him, how much extra does the new job have to pay him? Now it's just the difference. They have to pay him an extra $36.53 as a base salary because there's no bonus. Because in the other job, if they just pay him 80,000 here and 80,000 with the no bonus, then obviously he would rather take the first job, because in the first job he makes 80,000 minimum and he has a 25% chance of getting a bonus. So for sure he'll go for it. But now if the second job pays him 83,653, now he would be indifferent. He would be equally appealing because in the new job, 8653 gives him this level of utility, 898. That's how we got this number, was by plugging that utility. And how much would the job give him that has a bonus? That's the step 1 number, 898, which is the same. So he's getting the same utility from both jobs in that case. So here we did not need to do step 3 because they didn't say how much extra. They just said how much does the new job have to pay him. Question number 2, it says a stock has an estimated CAPM beta of 1.4 while the annual rate on treasury bills are currently 2.5%. What are T-bills? Those are completely risk-free assets like government bonds. So you can assume those are risk-free. There's no risk because government can always make the money back from taxes. And the market is expected to earn 9% this year. According to the CAPM, the appropriate discount rate for this stock is. So what formula do you think you have to use here? Well, whenever I see risk-free, return on the market, CAPM, I'm using my CAPM formula. And for those of you that took the crash or weeklies, I had given you a little cheat sheet attached to it. If you didn't see it, you can go back and check in your resources under crash course and weeklies, and you should be able to find this cheat sheet. And in the next to this mock, I'll make sure it's attached as well. You can use that as a rough guideline. Make your own cheat sheet, add in formulas as you like, but this is one that I thought had like the most efficient things on there. Like I put in a bunch of extra definitions, some of which are not that important. A bunch of the graphs from supply and demand, elasticity, and so on. So I'm going to look for CAPM here. You see it's right here. The CAPM, there's one formula there. But in this one, it uses standard deviation of the portfolio, standard deviation of the market. They didn't give us those numbers. So then I look around, what else do I have under CAPM? All of these are kind of related to the CAPM. So this one is also a CAPM formula. And this one looks like the one we need because I have a beta, I have a risk-free, I have a return on the market. So let's use this formula. I'm going to copy paste that. So in this case, which numbers do we have? Well, we have the risk-free is 2.5%. Here you could put it as a decimal, 0.025, or you could just leave it as a percentage. Doesn't make a difference. It'll give you the same answer. The expected return on the market is 9%. Minus the risk-free is 2.5%. Times the beta is 1.4. And that's it. That'll give you the K, or that's called the appropriate discount rate. Or that's also called the required rate of return. And this gives me 11.6%. Now, if you had put everything as a decimal, you would get the same answer, but it would have been 0.116. So then you just times it by 100 at the end. So sometimes you need to divide. In this CAPM, you don't have to divide by 100. It's just faster. Question 3, it says, refer to the previous question when answering this question. Jasmine strongly believes that the CAPM was correct in the long run, and the stock she was looking at is currently offering 13% return per annum, per year, that means. What action should she take and why? So the CAPM is basically the correct price or the correct return. That's what it should be according to this. So the K is basically 11.6. That's the required rate of return. That's what it should be paying. But right now it's currently offering 13%. It's offering more. So if the expected return is higher than the CAPM, 13% is bigger, or you could say basically the expected return of the individual stock, is greater than the required return, then is that a good thing or a bad thing? That's a good thing. That means that you should buy it because you're making more now. You're required to only make 11.6. That's like the fair return. But it's actually paying you 13, so that means it's a good thing. You're making more. So that means, is it overpriced or underpriced? Well, the return is higher, but that means the price is lower. It's underpriced. Like, let's say right now it's at $100, but it should be trading at $105 because its return is higher than what the fair return is. Fair required return was. So that means it would be underpriced. So A is wrong because it says overpriced. B says she should buy the stock. Is it apparently overpriced? No. Again, it's underpriced because the return is higher. Whenever the return is higher, it's underpriced. It's opposite what you think because we're talking about price. The higher the return, the lower the price or underpriced it is. She should neither buy nor sell because it's fairly priced. No, fairly priced would have been if it was 11.6 here. Then that means the K and the expected return of the stock, I is the individual stock, are the same. She should buy the stock as it apparently underpriced, yeah, and the price will rise as the market realizes this, yeah. Right now, if it's underpriced, if it's at $100 and it should have been $105, eventually people are going to start catching on. They buy it, and then as everybody wants to buy more of it, the price goes up to 105 or whatever the correct price is. And D says she should not buy the stock as apparently overpriced. No, all the other ones are saying overpriced. So it's D. Question number 4, it says in a market supply and demand, where Q is the quantity and price, what are the price and quantity traded in equilibrium? That's easy. Just make it equal to each other. So you're going to get, the QS is just equal to P. So it's P equals 100 minus 4P. Make them equal. So I bring negative P to the left. It's going to become P plus 4P, which is 1P plus 4P, which is 5P, equals 100. P is going to be 100 divided by 5, which is 20. And then Q is just equal to P. So Q just equals to 20. Or you could plug it back in this one, and you would get Q equals 100 minus 4 times 20, which is also 20. So either way, you should get the same answer. So the P is 20 and the Q is 20. That's E. Part of 5, it says, refer to the previous question. To answer this question, what would be the value of the deadweight loss if the government imposes a $2 per unit subsidy? So if they make a $2 per unit subsidy, there's 2 ways you can solve. First thing is always draw a graph out. And what does the supply curve look like? If it's just QS equals to P. That means the supply is starting at the origin. Because if you plug in like here, the Q is 0, the P would also come out to be 0 because Q is P. So 0 equals 0. And the demand always like this. And what is the vertical intercept of demand? Well, they wrote the equation as Q equals something P. So to solve for tax or subsidy, you should write it the other way. There's 2 ways to do it, but the way we learned it, the equation should be in the form of P equals something Q. So if I want to rearrange the supply curve, if it's QS equals P, that means P is just equal Q if you just write it the other way. And how would I rewrite the demand equation? QD equals 100 minus 4P. If I want to write it in the form of P equals something, I would bring negative 4P to the left. It becomes positive 4P. And bring QD to the right. It's going to be 100 minus QD. Or I could just say 100 minus Q. And then how can I get P? I divide everything by 4. So 100 divided by 4 is 25. And what's Q divided by 4? That's the same thing as saying 1Q divided by 4. So that would be 1 over 4Q. Or you could say 0.25Q. Okay, again, I found this by doing 1 over 4. Because it's 1 over 4Q. If you do Q divided by 4, which is the same thing as saying 0.25Q. Whenever it's a letter divided by a number, it's just like saying 1 over that number. If it was 5P on the left, on the right, you would do 1 over 5. So now it just makes it easier to see what is the intercept of demand up here is 25. Because if you plug in Q as 0 into this equation, you would get 25 minus 0 is just 25. Because at this point, the Q is 0 on the demand equation. Or you could have just plugged in Q as 0 into the original equation they gave you. You would still get the P is 25. If you did 0 equals 100 minus 4P, you would get 4P equals to 100. And then again, P is 100 divided by 4, which would give you 25. But the reason why I'm doing this is because we're going to need to do 3 steps for the subsidy. Now, first thing is in a subsidy, the government is giving money to the business or taking money from the business. In a subsidy, the government is giving money to the business, like recycling companies or environmentally friendly companies or universities. And was that going to allow the company to supply more or less? More. So I make an imaginary line on the right of equilibrium. In a tax, you make an imaginary line on the left. Or you don't need to make an imaginary line. You could say it's kind of like the supply is shifting to the right because the business can supply more. So this is the supply increasing. So I can actually rub off the other dotted line just so you can see the supply shifting right. And now, do we add the subsidy or subtract the subsidy from supply? Remember we said subtract subsidy from supply. In a tax, you add it on because the price is going up. In a subsidy, you subtract from the supply. So step 1, we can say subtract subsidy from supply. But the equation has to be in the form of P equals something. That's why I wrote it like this. So the supply curve was P equals to Q. So now the new supply curve, I'm going to say P equals Q minus 2 because it's a $2 subsidy. That's the equation of your new supply. It's Q minus 2. That means like if you kept going here down to the vertical intercept, it would be starting here at negative 2. But you don't need to draw that. Now step number 2 is the same in tax and subsidy. You make your new supply equal to demand. The reason why we needed it in the form of P equals something because it's the price that's decreasing by 2. It's not the quantity is decreasing by 2, it's the price. That's why you need it in the form of P equals something. So in this case, I'm going to get the new supply, which is Q minus 2, is equal to the demand, which is 25 minus 0.25 Q. And now you can try solving for the Q. So if I take the negative 0.25 to the left, you're going to get Q plus 0.25 Q, which is the same thing as saying 1.25 Q. Because that's 1 Q plus 0.25 Q, that's 1.25 Q. And bring the negative 2 to the right, it's going to become 25 plus 2, which is 27. And then you're going to get Q equals 27 divided by 1.25, which will give me a quantity of 21.6. So that's the new quantity up here is 21.6. And how can I get my two new prices? Well, you can first of all plug the quantity back into either of the two equations that you just made to equal to each other, either the demand or the new supply. I'll just plug it in demand. So I can say P equals 2. In the demand, it was 25 minus 0.25, and I plug in the Q as 21.6. And that gives me a price of 19.6. That's the price over here. Now, in a subsidy, is that the price that the consumer pays, or is that the price the producer receives? The lower price is always what the consumer pays in a subsidy, because they're making it cheaper. Like when they give a subsidy to the university makes the courses cheaper for the students, so more students get educated. And for tax, it's the opposite. Like on cigarettes, they tax it so consumers pay more. But subsidy, they want consumers to pay less because for good things, they want people to buy more of it. So this is the price of the consumer, and how can I find the price of the producer? I take this 19.6 and I can just plus $2. It's a $2 subsidy, so that would be 21.6. So up here, if I take this quantity and see where does that hit the original supply curve over here, that's the price that the producer receives. And how's that possible? If I'm paying 19.6, how can the producer be receiving 21.6? Where's the remaining $2 coming from? That's the subsidy. It's coming from the government. And in this case, what is the deadweight loss? In all the other graphs, the deadweight loss was normally on the left. The quantity is decreasing. So normally the deadweight loss would have been like a triangle here when the quantity is going down. Subsidy is the only one where the quantity increases. So instead of being that inner triangle, it actually becomes this outer triangle. This is the deadweight loss because this represents the area that the government is losing that's not being gained by consumers or producers. Because even though consumers and producers are happy, the government is losing money. And where does government get its money from? From us. So it's a loss to society. Anytime the government steps in, there's going to be a deadweight loss. Whether it's a price ceiling, price floor, quota, tax, or subsidy. The only time there's no deadweight loss is when we're at equilibrium, when there's no government intervention. In this case, you didn't even need those two prices, because if I want to find the area of this triangle, I know what is the base, or you could call that the height. The base of the height is just $2. Whatever was the subsidy, that's the gap in the two prices between 19.6 and 21.6. I was just showing you how to get those numbers. And what about the base, or whatever you want to call base and height, whatever, I can say this is the base. Well, for that, it's just from here to here. So I need this old equilibrium, which we found in the previous question. The old equilibrium quantity was 20. So that's why when you're drawing a graph, it helps make sure that you didn't make any mistakes, because it makes sense. 21.6 is on the right, 20 is on the left. So now I can say that the deadweight loss is equal to a base of 1.6, or you could say 21.6 minus 20, the old equilibrium to the new quantity equilibrium, times the height of the triangle is 2, times a half, which would just give us 1.6, which is A, or approximately 1.6, same thing. Okay, so definitely memorize your subsidy steps, and if it was a tax, then the only thing that would change is step 1. Instead of subtracting, you would have added the tax. So here, instead of minus 2, it would have been plus 2. But then all the other steps are the same, and the supply would have been shifting left. So the quantity would have decreased, which we'll do that in that later question. What else could they have asked you? What's the consumer surplus here? For the consumer surplus, you take the consumer's price and everything above it. So till from 19.6 to 21.6, and then you go up along the demand curve. So the consumer surplus would have been this entire triangle here. And what would have been the producer surplus? The producer surplus would have been from the producer's price, 21.6 till the supply, and then you go everything down along the supply curve. So all of that would have been the producer surplus. And what's the cost of government? You don't need to see that on the graph, but the cost of government is basically just $2 per unit times the quantity of 21.6 units. The government is paying all of this rectangle. You don't need to see it on the graph, you just think about the logic. It's $2 per unit times the new quantity. So 2 times 21.6 would be the cost of government. Okay, just brainstorming what else they could ask you. Question number 6 says, which of the following investment accounts is forcibly converted into an RRIF, and what triggers that conversion? So this is just like a little definition in the textbook. It doesn't come up often, but it's just a theory. If you had to guess, what would you guess? Well, they say RR in the question. So that means it has to do with RRSP. That's RRSP is Registered Retirement Savings Plan, and RRIF is Registered Retirement Income Fund. So what's the difference? Well, throughout your career, you're putting money into your RSP, which you can reduce from your taxable income. But then at the retirement age, which is 65, or I think now they've increased to 67, at that age, you have to forcibly convert your RSP into an RRIF. And at that point, you can start withdrawing from that account. So you cannot reduce it from your taxable income anymore. So both A and B say RRSP, but A says if the account reaches a certain value. No, it's not if it reaches a certain value. Like, it's not like, oh, once it hits $1 million, now you have to convert it. It's once you reach a certain age. At that point, like 65 or 67, whatever it is, then you have to convert it. So B is the correct answer. C says TFSA. No, that doesn't apply. TFSA, you can keep adding. It's a tax-free saving account. You can just add it. You could put a certain amount a year, and there's a maximum limit like $80,000 or $90,000 that you could put in total. But in RSP, you can put more and more as your income increases, only up until retirement. And also C is wrong because it's abusively used for excess trading. No, there's no such conversion. D, the TFSA, and if the account is second such account a person tries to open. No, that's not true. So it's only B. Question 7. It says Concordia Inc. recently issued a bond that trades at 8.5% of its par value and pays 4% of its face value, APR compounded and payable quarterly. If the bond had 5 years and 6 months until maturity, what is the YTM, effective annual rate, on this bond? Okay, a lot of information. First, let's start with the 98.5%. What is 98.5% of its par value? Well, if they don't tell you, you can assume the par value is $1,000. That means that's the face value. It's not always 1,000, but if they don't tell you, that's the rule of thumb. So what is 98.5% of that? You would do 0.985 times 1,000 times its face value, so that would be $985. That is your present value. You're going to put in your financial calculator, negative 985. Remember, in your calculator, always put the PV as a negative and FV and payment as positive. As long as they're different signs, it doesn't matter, but we should just be in the habit of putting PV as negative, FV as positive, so there's consistency in all the questions. And it pays 4% of its face value. That means that is the coupon rate. So if that's the coupon rate, then how can I find the coupon payment? For the coupon payment, you can take the coupon rate times the face value divided by F. F is the number of payments per year. So in this case, the coupon rate is 4%, 0.04, times the face value you're assuming is 1,000 if they don't give it to you. Divided by F, they said it is payable quarterly. So that means it's going to be 4. There's 4 quarters in a year. So it's like every 3 months. So that would be 40 divided by 4, which is 10. Then what is going to be our N? N is the number of payments. So here they said is 5 years and 6 months, which is basically 5.5 years. But how many payments is that? That would be 5.5 years times 4. Because there's 4 quarters in every year. They're making 4 payments per year times 5.5 years. So that would be, what is that, 22? Yeah, that's 22 total payments that the bond is going to pay in 5.5 years. 4 times per year, quarterly, times 5.5 years. What is the FV? That's the future value or face value, which you're assuming is 1,000 if they don't give it to you. And now you can compute IY. So let's pull up the financial calculator. So here I'm going to put 985 negative is my PV. 10 is my payment. 22 is my N. 1,000 FV. Compute IY. And this gives me 1.0769. In your calculator, it always gives you the IY already as a percentage. You don't times that by 100. But this is the effective interest rate quarterly. This is the quarterly rate because we had everything in quarters here, right? The payments were quarterly and the N was the number of quarters because we times it by 4. So this we can say is the effective quarterly rate, or I could say EQR. Now, how do I convert that into an effective annual rate? When they say YTM, they're asking for the IY. The yield is the same as the IY, but on an annual basis. For this, you can use your effective to effective formula. And what was our effective to effective formula? Let's go to our cheat sheet, actually. And if you go to the top left, you see the second formula there. It says effective to effective. We're going to use this formula here. So in this case, for effective to effective, I'm going to go from an effective quarterly rate to an effective annual rate. So I'm going to say it's 1 plus the K. The K is the number you just found, but you have to put that as a decimal. So it's 0.010769. I'm going to take this IY that we got and divide it by 100. In the formula, you have to plug it as a decimal to the power of old F over new F, and then you have to minus 1. So what's the old F? It was quarterly, the rate that we got. So that means it's 4 payments per year. So the old F is 4 divided by the new F. The new F is 1 because we want to make it an effective annual rate, which is 1 payment per year, and then minus 1. This will give us 4.377, or they rounded it 4.38%. If you minus 1, you get 0.0438, which is 4.38%, which is B. Question number 8. It says WisePrep has a project that will add $850,000 to after-tax profits in the first year and will grow by 0.5% per year thereafter. What does that mean, 0.5%? What letter is that? That's the G. That's the growth rate. So whenever it's a growth rate, it's going to be either a growing annuity or a growing perpetuity. If the cost of capital is 7% APR compounded annually, that means if it's compounded annually, that's your APR and that's also your effective rate. Because remember, the effective rate is, or you could say like in this case, the effective annual rate is 1 plus the APR over M to the power of M over F minus 1. M is the compounding, F is the payment. So in this case, if you do 1 plus 7%, that's 0.07, over M, if it's compounded annually, M is 1. And you're assuming the payments are also once a year. If they don't tell you, you assume that F is 1 payment per year. If they don't say like monthly payments, quarterly payment. So here, the 1 and 1 cancel out, 1 minus 1. And here's just 0.07 to the power of 1, which is just 7%. So you just get the same APR as the effective rate, so you don't have to calculate that. I'm just showing you why. When they say compounded annually, that is the effective rate. If the payments are also annually, or if they don't mention it. And the project costs $14 million today. What is the expected increase or decrease in the value or retained earnings to WisePrep if they do the project? Now, when they say what is the expected increase or decrease in the value, what is the value talking about? That's talking about the NPV, the net present value. And what's the formula for net present value? Is that in our formula sheet or in our cheat sheet? Yeah, it's right here. It's the present value of your inflows minus the present value of your outflows. Meaning, basically all the money that you're going to be making, the present value of that, minus all the money that you're going to be spending, which is usually just the initial cost. So here, what is the present value of my inflows? To find the present value of your inflows, you are going to use the formula for a growing perpetuity, or you could use your DDM, dividend discount model. They're the same formula. So it's growing because it is a G, growing at 0.5%. And they didn't give you any timeline. Annuity, it would be like for 10 years, for 5 years. But here they just said for the first year, and it will grow by 0.5% thereafter. So that means forever. You're assuming then it's forever if they don't give you a time span. So if you go to a growing perpetuity, that's right here in the cheat sheet. Or if you use the DDM, dividend discount model, it's the same formula, but we put D1. Where is the dividend discount model here? Here in the bottom. You see it says DDM. That's D1 over K minus G. That's the same thing as saying the first payment that you're getting over K minus G. It always gives you the present value one period before, which is the same thing as saying this, payment 1. Instead of dividend, it's a payment. So here I'll just use growing perpetuity, but sometimes in the solution they put DDM because it's the same essential formula. So here I can say the present value of my inflows is going to be the first payment you're getting is $850,000. Divided by the K is the 7%, but here you have to put as a decimal, 0.07. Minus the G is 0.5%, so divide that by 100, it'll give you 0.005. You have to put everything as a decimal here, so divide all the percentages by 100. It's going to be 850,000 divided by 0.07 brackets minus 0.005 close brackets. It's going to give me 13 million. So I'll just write it here. It's 13,076,923.08. That means all of these payments that you're going to be getting. They said in the first year. So in the first year means that's at year 1. And I can paste the formula underneath. This is the formula I'm using. So that's the payment 1. The PMT 1 is this number, 850,000. Divided by the K minus G, that was this. And that gave us this number here. The present value of all those future payments. If you get 850,000 forever, that's worth 13 million today. But what is the present value of your outflow? What do you have to pay today is 14 million. So that you don't need to calculate present value because that's today. So that's already discounted. You don't need to discount it back. So in this case, your NPV will come out to be negative. If you do 13,076,000, answer minus 14 million. That gives me negative 923,076.92, which is B. So should you take on this project? No. When the NPV is negative, that means it's not profitable because it costs you 14 million, but the present value of all those future payments that you're going to be getting in perpetuity is only worth 13,076,000. So you're going to lose 923,000 by taking on this project. You only want to take projects that have a positive NPV. Question 9. It says Naomi thinks she will earn 95,000 in 2025, on which she will pay 36,454 in taxes. However, if she gets a raise and earns 110,000, she thinks her taxes will total 43,255. What is her average and marginal tax rate? Okay, so first of all, to get her average, you can take, they said, if she does not get the raise. So if she does not get the raise, you take her original numbers. Her original income is 95,000. Original taxes is 36,454. And just divide them. This will give us 0.3837. If you times that by 100, that's 38.37%. And what is her marginal tax? Marginal means the additional tax she's going to pay if her income goes up. So you're going to see what is the change in her taxes. Take the difference between these two numbers. So her tax is going to go new minus old, 43,255 minus 36,454. I want to see what is the change in the taxes, how much additional taxes you have to pay, divided by how much your income increases by. From 95 to 110,000, it's increasing by 15,000. This would give me 0.4534. If you times it by 100, it's 45.34%. Or they just rounded to 45.35, so that's D. They asked for her average tax first. So be careful because in A, it gives her, they said what is her average and marginal tax. In A, they put the marginal first. So it's D. Average is this, and marginal is this. So average just means, and that's why they told her she does not get the raise, because you don't know which income to use for the average. It's using her old income without the raise. And for the marginal, you take the difference. How much additional tax for how much additional income. So on that extra $15,000, she had to pay this much additional taxes. 43,000 minus 36,000, that's the additional tax. So she had to pay 45.34% extra tax on that extra income. Question 10. It says BMO has just called Khalid to let him know he has a balance owed of this much, 12,545 on his line of credit. If the rate on the account is 21.25% APR compounded quarterly, how long will it take, rounding up, to fully pay off the line of credit if he can only afford to pay $240 per month? You may assume that he does not make any further purchases. Okay, so a lot of TVM questions that you can expect on the exam. First of all, I need to find my effective rate. Now he's paying per month. That's what you use. So here the compounding is quarterly. That is the M. So the M is 4. M is compounding. But he's paying per month. So that's the F. F is 12. 12 months in a year. So in this case, whatever is the payments, that's what you have to find the effective rate of. So am I going to do effective quarterly rate or effective monthly rate here? Well, the payments are monthly. So that means you have to find the effective monthly rate, or I'm going to put EMR, which is 1 plus the APR, that's 21.25%, divided by M. M is 4, to the power of M over F, which is 4 over 12. minus 1. This will give us our effective monthly rate. Remember to put to the power of 4 over 12 in brackets in your calculator. This gives me 0.0174. And you could put that as even more decimals, so 7404, to avoid any rounding mistakes in your financial calculator. Now you can put the payment. So this is your like IY that you're going to put in your calculator. The payment is they said 240 per month. The N is what we're trying to find. It says how long will it take? How long means what's the N? So we have to compute N, so that means I must have everything else. The balance owed is this much, so that's the PV. So I can say PV equals, and you could put it as a negative 12. Always put the PV as a negative to be safe. Sometimes it doesn't matter. Here it does, because it's always got to be opposite sign to the payment and the FV. It's like an outflow. You could think about it as an outflow. That's what I owe, and the payment is what I'm making. So it's PMT, IY, what am I missing? FV you can put as 0. There's no future value. And now compute N. So here I'm going to put this 0.0174 times it by 100. So it's 1.7404%. That's my IY. 240 is my payment. 12,545 negative is my PV. 0 FV. Compute N. That gives me 139.38. And that they said per month, so that's monthly payment, so that's the number of N, that's the number of months. But they said round up. So that means you would round it up to 140 months. Because 0.38 of a month, you wouldn't have paid it off in 139 months. You have to make at least 140 payments to pay it all off. Question 11, it says, using the same information as above, what percentage of his total payments were used to pay interest? So how can you figure out the amount of interest he's paying? Well, first figure out how much is he paying in total. He is paying $240 per month. So you could say his total payments are 240 times how many months? We just found in the previous question he's going to make 140 payments of $240. So that means his total payments is 240 times 140, which would be 33,600. That's how much he's paying in total. If you add up all of the payments, $240 each month for 140 months, that means he's going to pay 33,600 total. And out of that, how much was the principal? The principal was just the amount that he owed, 12,545. So if I take this number and minus out the 12,545, the difference must be interest. This is like his principal, what he owes. And so the rest is interest. So give me 21,055. That's how much he's paying in interest in total, but that's in dollars. The question is asking what percentage of his total payments. So how would I find this as a percentage? Just take this and divide by his total payments. Take this number and divide it by 33,600. So I can say in interest he's paying 21,055 divided by 33,600. And that will give me 0.6266, or if you times it by 100, that's 62.66%, which is A. Okay, so take his total payments minus the principal, or how much he borrowed. That's the interest, and then divide it by the total payments to get it as a percentage. Now, sometimes, like in the solution, instead of taking 140, they might have done 139. Like if you had plugged in here 139.38, the number of months you got here, or if you had rounded it down to 139, all of those would still give you very close to the same answer. It would be like maybe 0.2 off. It would be like 62.4% or 62.5%, which is close enough. You just take the closest answer in that case. Doesn't matter. 140 makes sense because that's what we did in the previous. But sometimes in the solution, they might put like 139, like the actual decimal to the decimal that you actually paid. And you'll get very close. They're not going to confuse you and put two answers that are using both, because technically they're both kind of right. You know, you're making 140 payments total, but technically it's supposed to be 0.38 only on that last payment. You're not, all of that is going to interest because you're not making the full payment on that fourth month. You're just paying off the balance. A car insurance contract that makes payments if certain conditions are met is most like or can be thought of. This is also a weird theory question that they put. What is car insurance? Basically, like the insurance company will pay you if you keep the car in a certain condition. Like, for example, the tires, the engine, the oil change, things like that. If it doesn't get dented, then they're going to give you a certain payment for the car at the end of whatever it is, at the end of 5 years, whenever your lease is up. So it's on the condition that you keep it in proper shape. Or like if you get into an accident that it wasn't your fault, that could be a condition. And that is similar to a derivative, which is A on the car condition. A derivative is basically called options and futures, which we saw briefly when we were looking at the theory in our crash course and weeklies, talking about, like, for example, the mortgage crisis, the mortgage-backed securities in 2008 when there was a financial crisis. A lot of banks were trading derivatives, options and futures, and those were very risky. An option is basically a derivative that says, all right, I have the option to buy this stock at a certain price. Like, let's say that's a call option at like $100. So now if the price goes up to 150, 200, I can still buy it at that 100. Or you can buy a put option, which is also a derivative. That means you buy the right to sell the stock at a certain price. I want to sell my shares at $100. So now if the price drops to 50 or 40, I can still sell it to my broker for $100. So it depends which way you think the stock is going to go. Some people buy the call option to buy it at a price, and some people buy a put option to sell it at a certain price, but you have to pay a fee for that, like $2, $3 fee to exercise that option, to be able to use that option. So in this case, it's the same thing with the car insurance. You're basically able to sell your car. You're buying the put option to sell the car to the insurance company after 5 years, as long as it meets this certain condition. Instead of selling it at a certain price of $100, you're saying that I'm going to sell it at a certain condition. And actually, you're deciding the price too. You decided in advance in this insurance contract, okay, in 5 years, you're going to give me $10,000 for this car, as long as it meets these specifications, like the engine, the oil change, the tires, everything. There's no dents. As long as that's fine, it doesn't have a certain amount of mileage, not over 50,000 miles, then the insurance company will buy it off me for $10,000, which is kind of like an option to buy or sell a stock. But the other ones, B says an equity stake, like a share in the car. No, they're not buying ownership in the car. You have the option to sell it as long as you keep it in good condition. A loan, no, again, the loan is just, it's not related to the car. You just have to pay that no matter what. An RSP, as there are no taxes at any point in the contract. No, RSP is a retirement plan that doesn't really have anything to do with car insurance. So it's only A. It's not all of the above. Question 13, it says a T-bill with a face value of 1,000 and 5 months. So remember, Treasury bill is basically a risk-free government bond that says no coupons. So if they don't give me any coupons, like normally a bond pays you like 4%, 5% a year, a T-bill doesn't pay me any coupon. So then do you think they have to sell me the bond at a discount or at a premium? They have to sell me the bond or the T-bill at a discount. Because if I buy it for 1,000 and then 3 months later just give me back 1,000, well, I didn't make any money and I didn't make any coupon. So they say, okay, we won't pay you a coupon, but we'll sell you the bond at a discount. Instead of 1,000, we'll sell it to you for 900 today. And then in 3 months time, or in this case in 5 months time, we'll give you 1,000, the face value. So at least I made like $100 profit there, or capital gain, that's called. So in this case, they said the maturity is yielding 3.5% EAR. What should be the current price on this bill. So current price means we're trying to find the PV. So you can use your financial calculator. Remember, if you don't have a financial calculator, borrow one from a friend. It's going to save you a lot. There's formulas for all of these, but it's way easier to use your financial calculator. I'm going to put the FV as the future value, is usually 1,000 face value. Now, what do I put as the N? It says 5 months, but they gave me an effective annual rate. So I have to convert this into a yearly basis. I cannot put 5 as my N because that's 5 months. Your months, your payments, F has to be consistent with your rate. If it's an annual rate, then it has to be annual. So, or you could have converted the effective annual rate into an effective monthly rate, but that would take you longer. So I think it's easier just to convert 5 into years. 5 months, you would just do 5 over 12 to convert it on a yearly basis. 5 over 12 is 0.4166 reoccurring. Your IY is 3.5, so now I can just leave the IY as it is because everything is on an annual basis. And I put payment as 0 because there's no coupon payments on a T-bill, and you just compute compute PV. So put 1,000 FV, 0.41666, plug in a lot of 6s as your N to avoid rounding mistakes. 3.5 is my IY, 0 is my payment, compute PV, gives me 985.77. That's the price today, that's E. So that means they're going to sell it to me at a discount. I buy it today for 985, and in 5 months they're going to give me back 1,000. So the difference is like my profit, my reward for lending the money. Question 14, it says the government of Germany just announced that it's against the law to charge more than 45% effective annual rate on any loans. What would be the highest APR compounded monthly under this new law? So we're going to use our effective rate again. So the effective annual rate is going to be 1 plus the APR divided by M to the power of M over F minus 1. Remember, whenever they say something compounded monthly, that's automatically the APR. Even if they didn't say APR in the question, whenever they say compounded monthly, compounded quarterly, that means the rate that they're giving you. Like if they say 6% compounded monthly, that 6% is the APR. So in this case, they're telling us that the effective annual rate has to be 45%, or I can put that as a decimal, 0.45. 1 plus the APR is what we're trying to solve for. M is 12 because it's compounded monthly. And to the power of 12 over, you're assuming always the F is 1. If they don't tell you, you assume it's 1 payment per year because we're trying to find the effective annual rate. So that means 1 payment per year minus 1. So the first thing I can do is take the negative 1 to the other side. So here it's going to become 1.45. If you do 0.45 plus 1, it's 1.45 equals 1 plus APR over 12 to the power of 12 over 1 is just 12. Then what can I do? Take the 12 to the other side. So you're going to do 1.45 to the power of 1 over 12. Remember, whenever you bring the exponent to the other side, it becomes the power of 1 over. That's 1 plus APR over 12. And 1.45 to the power of brackets, 1 over 12, close brackets, is 1.031448 equals 1 plus APR over 12. Then I bring the 1 over to the side, so it becomes APR over 12 equals this number minus 1, which is 0.031448. And then lastly, you times 12 to cross multiply. So if I take this number times 12, I'm just keeping the answer in my calculator so there's no rounding. That'll give me 0.3774, which is basically 37.74%. If you times it by 100, that's B. Question 15. It says the island of Fiji suffers from severe economic decline principally due to. So it doesn't matter what country they give you. If it's a severe economic decline, A says exhaustion of depletable resource. That's true. A depletable resource would be like oil or copper, nickel, steel, any kind of natural resource they have, if there's a depletion of it, if they run out of oil, run out of steel, run out of nickel, run out of copper, well, it's going to lead to an economic decline or severe decline. But why not the other ones? Like B says excessive taxation. Well, all the other four are talking about ways that the government can step in. And that wouldn't lead to a severe economic decline. Like, yes, it can lead to a deadweight loss. A loss for the consumers and producers in that product. Like a tax leads to a deadweight loss. But, well, the government is going to make money in tax. And then they can use that tax to re-inject. So that would not lead to a severe economic decline. It might lead to some deadweight loss. C, extreme market frictions or inefficiencies. Market friction means any way the government steps in. Price ceiling, price floor, quota, tax. Brought about by too many regulations. Again, when the government steps in, it can lead to a deadweight loss, but not a severe economic, not for the whole economy. Like if they tax cigarettes, the cigarette producers are going to be unhappy, but not the whole society. It's not going to lead, well, it will lead to a deadweight loss for cigarette consumers and producers, but not the whole economy. D, a lack of investment opportunities resulting from economic sanctions imposed by Western nations. Again, that would be a government in a Western country imposing that tariff or whatever it might be, a tax. So anytime the government steps in, it's not going to lead to a severe economic decline. Only a small deadweight loss or a medium, whatever deadweight loss for that industry. So these are all industry specific. Enforced use of an antiquated means an old quota system. So a quota, again, is a way the government can step in. It's price ceiling, price floor, quota, tax. It's not going to lead to a big economic decline in the whole economy. So all of these others would just affect individual industries. Only A would affect the entire economy, because if it's a big resource like oil or a natural resource, land, now the country is going to suffer because there's not enough space, there's not enough land, there's not enough oil to run the machines. So that would affect all the industries. Question 16. The principal advantage of an ETF, such as a North American Market Index ETF over other mutual funds, is that, so a mutual fund normally invests in like 200-300 companies. An ETF is like 2,000-3,000 companies. And normally they have very low management fees, like 0.4, 0.5%, because there's no portfolio manager like you have in mutual funds that normally charges 4, 5, 6%. So over many years, that can add up. That little percentage, 0.5% versus 5%, can make a huge difference. So that's why generally in the textbook, in your notes, they suggest that ETFs are a better investment, because the average portfolio manager does not beat the market anyway. So you're just paying that 4 or 5% for nothing. So it can have a portfolio of diversified investments. Well, that's true in both. In both of them, you have many different companies, so it's diversified. The main advantage, though, is the fees. So it's not A. It can invest in public companies. Well, both of them can invest in public companies. So that's not true. It has a superior performance in active. No, it has pretty much the same performance. It can minimize fees. Yeah, that's exactly the main reason. So it's D. Investors given the simple strategy. Simple strategy is just we invest in 2,000-3,000 companies, and then if the whole industry or market goes up, then all of those on average will go up, and it's going to be pretty much the same as the S&P 500 or the mutual funds. So you just save on the fees. Question 17, it says Layla is saving for some new furniture using her RSP account. She has the money invested in a mutual fund that she likes. How much money must she invest today to be at least 85% certain that she'll have the desired $8,000 to buy the furniture in 3 years' time? Okay, so the first thing is, what if they had not said 85%? Like, what if they said she wants to be 5% certain instead? Then which one would she take? The highest return or the lowest return? You would take the highest return, right? Why would she make negative 4% when she can make positive 18% at least 5% of the time? So then she would have taken the 18% as her return, as her K. Now, what if they had not said at least 5%? What if they had said at least 40%? Then which two would you take? Then you would take the two highest, these two, because 38 plus 5 adds up to 43%, which is at least 40. It hits the minimum threshold of 40. And then between these two, which one would she be making at least of? She would be making at least 13%, right? because 38% of the time she makes 13, 5% of the time she makes 18. So, but she's making at least 13%. So you would take the lower of the two because she's not making 18% at least 40% of the time. But she is making 13% 40% of the time, because if she makes 13%, that automatically means, if she makes 18%, I mean, she's automatically making the 13%. So that you would have taken 13 in that case. So now let's make up another number. What if they had said at least 50%? Then what would you take? At least 50%. Now these two add up to 43. So then you would take the third one. You would take top three. 30 plus 38 plus 5. That's 68 plus 5 is 73. Which meets the minimum requirement of at least 50%. And then which one is the lowest out of these three is 6%. So at least 50% of the time she's making at least a minimum of 6%. Because if she makes 13 or 18, she's automatically making 6. But if she's making 6, it doesn't automatically mean that she's making 13 or 18. So you take the highest ones and take the lowest out of those highest returns. So now let's go back to the question. Now they're saying at least 85%. So to cover at least 85%, you're going to take all of these four. So 20 plus 30 plus 38 plus 5. Because if you added just 30, 38, that was 73. So anything up till 73%, you would have just taken the top three. You would have taken these three. And then picked the 6%, the lowest of the top three. Up until 73%. That's what these three added up to. But now it's higher than that. It's 85. So now we got to go to the top four. So in this case, out of the top four, what does that add up to? 20 plus 30 is 50. 50 plus 30 is 88. 88 plus 5 is 93%, which covers at least 85. And what's the lowest out of these four is positive 2%. So that's the number you're going to take. It's the lowest out of the top returns that cover the range you're talking about. So basically you're kind of going backwards. You're starting at the highest return and then you're adding on backwards until you hit at least the number they give you. So if you just took these first three, that would not add up to 85. So you have to go to the fourth one. So that means this is the number we're going to use as the K. And how much does she need to invest if she wants 8,000? You could use your financial calculator or you could use the present value formula. The present value is the future value divided by 1 plus K to the power of N. Or 1 plus R to the power of N. R and K are the same thing in your textbook. So they're saying how much does she need to invest today? So today meaning the present value is what we're trying to find. The future value is 8,000. And the 1 plus K we're going to use 2%. So that's 1 plus 0.02, which is 2%. I'm not using the 20% here. I'm using the 2% return. Because it's the lowest number out of these four that she's going to be at least making 93% of the time. Because she's not, 85% of the time, she's not making 6%. She's only making that this many, 73% of the time. She's not making 13% that much. She only makes this many, this percent of the time, 43% of the time. She's not making 18%, that she only makes 5%. But if she's making any of those, then she's making at least 2% all of these times, 93% of the time, which is at least 85%. That's why we use that. And the N is 3, because it's in 3 years' time. So I discounted back 3 years. So 8,000 divided by 1.02 to the power of 3 gives me 7538.58, which is A. And if you wanted to use your financial calculator, that would have been fine as well. There's no mention of compounding in this question, so whatever's the 2% APR, you can assume that's the effective rate as well. So if you plugged in here to your financial calculator, 8,000 is the FV, 3 is the N, 2 is the IY, 0 payment, compute PV. It gives you the exact same answer, 7538.58. So you could have done it either way. And this formula for PV I also put in your cheat sheet. If you want to copy that down as well, it's over here near the top left. Present value for a lump sum. Like just a lump sum means it's not a recurring payment. A payment is recurring. This is just one amount. She wants 8,000. She wants to know how much does she have to save today. So if she saves 75.38 today, in 3 years' time, she would make 8,000 at least 85% of the time. Really at least 93% of the time, because these probabilities added up to 93. Question 18. ABC Inc. has issued a bond that is trading at a premium. What does a premium mean? That means the price is higher than the face value or lower? That means the price or the PV is higher than the face value of the bond, which means that the coupon rate is higher than the yield to maturity or lower. That means the coupon rate is higher. Like let's say this bond, the coupon rate is of one specific bond. Like let's say this Apple bond is paying me 10% and the yield to maturity is the average market rate, is only paying me 6%. So that means this bond is more attractive. They're paying you a better rate than the rest of the market. So then the price will go up because they're paying you a better rate. If I want to sell my bond to you, I'm going to say, well, I'm not willing to sell for 1,000. You got to give me at least 1,200 because my bond is paying you better than the rest of the market. Better return, better coupon. A says it must have a face value of 1,000 as all bonds have this face value. No, generally that's a rule of thumb, that's 1,000. But whenever they say all bonds, just be careful because that's normally when they say always, you might be missing something. So that's false. B, the face value must be above 1,000. No, the price must be above the face value, which could be 1,000, but the face value doesn't have to be above 1,000. So that's wrong. C, the coupon rate must be greater than the yield to maturity. Yeah, that's exactly what we said here. The coupon rate has to be higher than the yield to maturity. D says the face value must be higher than the price of the bond. No, the face value is less than the price of the bond. So C is true. Coupon rate must be greater, but D is false. The face value must be less. And E, this bond must be trading at a premium when the coupon rate is below YTM. No, it's trading at a premium when the coupon rate is above the YTM. So it's just C. Question 19, it says a positive risk premium is required. Remember, what was the risk premium? We saw that in our CAPM formula earlier. Remember, the risk premium was basically the expected return minus the risk-free. How much extra the stock has to pay you because it has more risk. And that is only true for risk-averse investors. Risk-averse means somebody that does not like risk, or that basically we could say is a risk avoider. So somebody that doesn't like risk, they would rather take risk-free. So you can only convince them to buy a riskier stock by offering them a higher expected return. So A is true. But why not B and C? Well, B says to induce risk-neutral investors. No, for risk-neutral investor, they don't care. So if I give them a riskier investment, like let's say I tell you we flip a coin 50-50, either you win $10 or you lose $10. Now let's say I give them a riskier project where I say you can either win $1,000 or lose 1,000. We flip a coin. For risk neutral, they don't care because in both cases, you have the same percentage of winning as of losing. It's just a bigger amount. But you could lose bigger, but you could also win bigger. So risk neutral doesn't care about the level of risk. It's the same expected return in both cases. It's 50-50 of winning or losing the same amount. So they'll take either one. So you don't need to offer them a positive risk premium. You don't need to give them any risk premium. And for C, to induce risk-seeking investors, risk-seeking is also called risk lovers. For them, you do not need to offer positive risk premium. You can actually offer them a negative risk premium. Because for a risk lover, like let's say they really want to flip the coin. So they'll say, you know what, flip this coin with me and I'll give you an extra $20 if you gamble with me. Because they like the risk. So they're actually willing to give up some expected return in exchange for more risk. So risk averse doesn't like risk. You have to give them extra money to get them to take a risky project. Risk neutral, they don't care whether it's risk free or risky, because in a risk free, let's say that they just make a certain amount. In the gamble, they can make more or less. So it kind of balances out for them. So you don't need to pay them an extra premium on top. And for the risk lover, they're actually willing to give up risk premium. You can actually give them a negative risk premium because they're willing to sacrifice because they love risk. They're willing to give you money to flip the coin with them. So in that case, it would be negative risk premium. So it's only A. Question number 20. One of the principal agent problems. So what is the principal agent problem? You might have seen that in COM 308 or 309, those of you that are taking that. The principal is basically the shareholders. And the agent is basically the one that represents the shareholders, me and you. That would be the CEO or the managers. And sometimes there's a principal agent problem when the CEO does not act in the best interest of the shareholders. Like let's say a CEO rents a private jet and writes it off as an expense to the company. The CEO doesn't care. It's not coming out of their salary, but it's coming out of our profits, our shares. So in a similar sense, what happened for the grade rankings on investments as made clear during the MBS crisis of 2008? MBS stands for mortgage-backed securities. So remember in that case, before 2008, a lot of banks were loaning out a lot of money to people with bad credit, and they were packaging these investments to their investors as mortgage-backed securities, saying, okay, invest in here, we'll give you like 15% return, and we're going to take your money and use it to loan out to people for their mortgages that want to buy houses. And don't worry, it's really safe. And they had all these insurance companies and government agencies kind of back it up and say, oh yeah, this is a safe investment, and say that it's safer than it actually was. And then when those people that lost their jobs, they couldn't pay back their loan, the bank took their house. But now nobody could afford to buy the houses, so the housing market crashed. The prices fell because nobody wanted to buy. And so then the bank had all these houses, but nobody wanting to buy them, so they lost billions and their investors lost billions. So that was a principal agent problem because the banks had nothing to lose. If they lose, they just lose their investors' money. But if they gain, they get to keep a percentage of the profit for themselves, for the bank's profit. So that's why principal agent problem is a bad thing, because you want the banks to have some skin in the game, something to lose. Otherwise, they're going to just give the loan to anybody. They're going to take on really risky projects and risky loans. So let's look through the options. A says there is a strong financial incentive to inflate ratings to the detriment or risk of investors. Detriment means to the disadvantage of the investors. Yeah, that's exactly what we just said. The banks had a strong incentive to inflate ratings, to say, hey, we have this insurance company and they're telling us this is a really safe mortgage-backed security. You have like a 90% chance to get your money back, but really it was like they only had a 50% chance of getting their money back with the interest that they promised. So they inflated the rating, saying, oh, it's really safe. Like there's A ratings, there's B ratings, and C. So they were saying, oh, this is A and B, but really it was C and D ratings, very risky. B, private industry cannot hire necessary experts to evaluate the risk of complex securities. No, they can. Private industry means like banks, non-government. They can, they just didn't want to, or they did and they just paid them off to give higher ratings so that they can get a lot of people to invest with them. If people knew the real ratings, they wouldn't have invested. C, investors believe that mortgages were risk-free investments. No, they never said it was risk-free. They just said it was lower risk than what it actually was. D, governments created too many regulations. No, government had too little regulations. If they were regulating it properly, the banks would not be allowed to get away with it. And then they got bailed out by the government because they were too big to fail. And then E, none of the above are principal. No, so it's just A. Okay, the fun part, long answers. Question 1, it says XYZ Inc. is considering offering a defined benefit plan, which has fixed payments to their employees. In the plan, workers would contribute Y dollars per month into the plan. The plan is presumed to invest the monthly proceeds into an ETF that's expected to net an after-tax annual rate of return of 13% EAR, effective annual rate. After retirement, the workers would receive $4,000 a month for an estimated 20 years. If the plan cannot meet the obligation, the employer would be responsible for paying any difference. The plan would also be used to purchase a $5,000 gift for the retiree on the date of their retirement and must account for this expense. And A says, how much money does the plan need to have on the date each employee retires? Okay, so for this, it would help to make a little timeline. So here, let's say you have the date of the retirement. And after retirement, it tells you that the worker would receive $4,000 a month for an estimated 20 years. So what does $4,000 a month mean? That means they get $4,000 here, or I'll just put $4K to save space. Then they would get $4K here, $4K here, $4K here, all the way for 20 years, but it's $4K a month. So how many payments would they get in total? Well, if it's per month, it would be 20 times 12. So here, if you do 20, there's 20 years times 12 months, it would be 240 payments altogether that they get. That's basically like your N. And also, they want to get $5,000 gift on the date of their retirement. So on this exact date, they're also going to give them an additional $5,000 as a gift. And if we want to find how much does the plan need to have on the date each employee retires, that means we need to find the present value right here. So first of all, what is this portion, do you think? Is that a growing perpetuity, growing annuity, ordinary perpetuity, or ordinary annuity? Well, it's not a perpetuity because it's not forever. It's for 20 years. They gave you a time span. So that means it's an annuity. And is it growing? Did they give any growth rate? No. So that means it's an ordinary annuity. So you could use the formula for an ordinary annuity, or you could just plug it into your financial calculator. Whenever there's no growth rate, you can just use your financial calculator. But I'm just putting ordinary annuity so you know what to follow. So here, like we said, the N is 240. There's going to be 240 payments. Each payment is $4,000. And what is your effective annual rate? That's your IY, is 13%. But the payments are being made monthly. So how can I find the effective monthly rate? You have to use your effective to effective formula. What was effective to effective formula? Remember, we had that in our cheat sheet. To get my effective monthly rate, I'm going to do 1 plus K, whatever was the effective annual rate, to the power of old F over new F minus 1. So in this case, that would be 1 plus 13%. So that's 1.13, because that's the effective annual rate, to the power of old F over new F. What's the old F? Is 1, because effective annual rate means 1 payment per year. But I want to find the effective monthly rate, which is the new F, 12 months in a year, minus 1. This would convert the annual into a monthly rate. So I do 1.13 to the power of brackets, 1 over 12. Remember to use brackets. And that will give me 0.01024. Basically, that would be 1.024%, or I could put even some more decimals like 368 to avoid any mistakes with the rounding. Because in your calculator, financial calculator, you have to put it times 100 as a percentage. And what is my FV? Is 0. Because we're not trying to find at the end of it, we're trying to find when you retire. All of these future payments, I want to see what is that worth at retirement. It's always, remember, one period before. So here they told you after retirement the worker would receive $4,000 a month. It doesn't mean on this date they get $4,000. The first payment comes after retirement. So when you discount all of these future $4,000 payments, 240 payments of $4,000 each, it gives you right here. So now I can press compute PV. So we do 240 is the N, 4,000 is the payment, 1.02368 is my IY, 0 FV, compute PV. That gives me 356,836.82. But is that my answer? What am I forgetting there? Is the 5,000. They have to give that plus the 5,000 on the date. This one you don't need to discount back because it's exactly on the date of their retirement. So you would take this number plus 5,000, and now this would give you the answer. So if I do 356.82 plus 5,000, that gives me 336.82. That is your answer. If you look at the present value of all of these future payments that they're going to get during retirement, $4,000 a month for 240 months, that would come out to be this number, plus the 5,000, that would come out to be this number here. That's what they're asking for. How much money does the plan need to have on the date the employee retires? They need to have this much money so that they can pay him $4,000 a month for 240 months. But that's taking the time value of money into consideration, because getting $4,000 10 years from the retirement date is not the same as $4,000 next year. Part B, it says, what must be the value of Y if the worker is expected to have, part 1, a 25-year career. So let's do that first. So if they have a 25-year career, now we're looking at the first half of the timeline, this portion. So here, if they have 25-year career, how many months is that? Well, actually, you could leave it as, is it a monthly? Yeah, you have to convert monthly because it says the plan is presumed to invest the monthly proceeds into an ETF. So those are monthly, it's Y dollars per month. So here you're going to have to do 25 years times 12 months, which will give you 250 plus 50, that'll be 300 months. So you're going to have to put the N is 300, which we find by doing 25 years times 12 months per year because the payments are monthly. And now what are you putting as this number here, the 361? Is that now your present value or is that your future value? Now that is your future value, right? Because you're looking at the first half of the timeline. So you want to see how many payments, how much does each payment have to be for these 300 months in order for it to be this amount in the future. Because in this, so for this portion of the timeline, the 361,000 was the present value because it was at the start of the timeline. But for this portion, it's at the end of that part of the timeline, so it's the future value. So we're going to say FV is your answer from part A, which is 361,836.82. What is your IY? Well, again, it's a monthly rate. So we already calculated the effective monthly rate, which was the same as the previous part, 1.02368. Now, in this case, if it was not monthly payments, if it was like quarterly payments, then you would have to find the effective quarterly rate instead of the effective monthly rate. And then you would have had to convert the payments into quarters. So you would have done, the N is 25 times 4 quarters in a year, for example. If they said semi-annually, then you would have had to find the effective semi-annual rate. And then you would have done 25 times 2, because 2 payments per year if it's semi-annually. But here it's just monthly, so we kept the same time frame as before. Now you're going to put the PV as 0. There's no present value at the start. You're not starting with any money over here, and this part becomes the FV. So we're going to say compute FV. So I put 300 is my N, 361,836.82 is my FV, 1.02368 is my IY, 0 PV, and a compute, not compute FV, I meant compute payment. FV we already put is 361, so the payment will be 183.09. So just cross this out. It's not FV, we're computing payment because we want to see how much are the monthly payments going to be. So that would be your answer, 183.09. That's for part 1. Now what about for part 2? If it was a 40-year career, you do the same thing, but you're just going to change the N. The N is now going to be 40 times 12. So that's 400 plus 80, that's 480. Everything else is the same, and then compute payment again. So I'm just going to change 480 equals N. Everything else is the same in my calculator, so I just press compute payment. Now they only need to make monthly payments of 28.11. And even though it puts it as a negative here, you just keep it as a positive because it doesn't make sense to make negative payments in your financial calculator. It just puts the opposite sign of the FV, but you're still putting it as a positive in your answer. So these two are both your answers. This is for the part 2. This is for the 40-year career. On the left was for the 25-year career. Part C, it says explain the difference between a defined contribution and defined benefit plan. A few points are sufficient to mention the risks to employer and employee without performing any calculations. Explain why dramatic improvements in life expectancy from the 1960s to the present made defined benefit plans so rare. Okay, so I couldn't really find it in your notes. I think there's maybe a certain part of the textbook that mentions this. Sometimes they put theory questions like this that are a little bit unfair, and you can still use some logic. It's only worth 3 marks. So one or two of the marks you could get just by looking around in the question. They actually told you what a defined benefit plan was earlier in the question. Go back and check. It tells you, in this case, they were doing a defined benefit plan, which was fixed payments to their employees, and it told you the plan presumed to invest the monthly proceeds. And it told you the employer would pay. Where did it say that? Employer would be responsible for paying any difference. So the effective annual rate is 13%. But at the end of the whatever retirement time was, if they don't come up with this amount of money, 361, like let's say they only had 300,000, the employer would pay the extra 61,000. So they're actually giving you half the answer. They're telling you what a defined benefit plan is. So we can answer that part first. So we could say like point 1. A defined benefit plan is when fixed payments are made and the employer pays the difference if the desired amount is not reached by retirement. The 361,000. If that's not reached, employer, so that means employer takes on the risk, because they said mention the risk to employee and employer, so employer takes on the risk. That'll get you 1 mark. So then what would it be for the other one? For the defined contribution plan? It's the opposite. So if you're not sure, just guess. Think, what else could I put? So for a defined contribution plan, the employer does not pay the difference. So the employee takes on the risks. So they're putting those fixed payments. But if, let's say, instead of making 13% effective annual rate, because they don't know, they think it's going to be on average 13% in this RSP or in this ETF or in this mutual fund, whatever the investment is. But if it doesn't hit 13%, let's say over the life of the employee, the fund only makes 10% or 9% or 7%. Well, then the employer says, tough luck, whatever you have, instead of getting 361,000, whatever's in there, if it's only 300,000 or 200,000, that's what you get. So now that's not good for the employee. They're taking on all the risk. So that's another mark. And for the third mark, it says, explain why dramatic improvements in life expectancy from the 1960s to the present made defined benefit plans so rare. Defined benefit plans were the first one, which was where the risk was being taken on by the employer. Because if people are living longer, then that's good for the employer or bad? Well, in terms of the investment, it's bad, right? Because if they're promising to pay the difference, well, now instead of living for 20 years after retirement, if the person is living 30 years, well, they need more money. So if the employer promised to pay the difference, it's going to be too expensive. So you could just put that in any kind of words. So you can say, like, as life expectancy increase, the defined benefit plan became too expensive for employers, so they stopped offering it. Anything like that. Or you could say they switched to defined contribution plans instead because the employer basically couldn't afford it anymore. Anything like that. That's a third mark. You could put it in your own words, as long as they said they're not like super strict on the marks. So as long as you get the rough idea across. So even if you didn't know that part, you could just kind of use the question to help you. Don't leave anything blank. Put something down. Look around in the question. There's going to be a hint. And then you can kind of use logic. Like if you know, okay, defined benefit plan was in the question. They told us employers taking on the risk. So let me at least write that down. Let me at least get 1 mark. Now, if I got 1 mark there, then what must be defined contribution plan? Well, here they're telling you who's the risk going to, employee or employer. So here, if it's employer, then in the second one, in contribution plan, it must be on the employee. How could it be on the employee? Well, in the question, they told you that in this one, the difference was paid by the employer. So here, the difference must be the opposite if I had to guess. The difference is not paid by the employer. So if it's not paid by the employer, that means the employee is taking on the risk. So you could just kind of use logic and work backwards. And then for the last part as well, if life expectancy is increasing, well, it makes sense. Defined benefit, the employer is taking the risk, so they got to pay more. So that one you could logic too. So in question 2, it tells you you're the CEO of Wisebook. You produce university textbooks, and I'm thinking of launching a new textbook. They give you the monthly demand and supply. And so it tells us here, find the expected monthly sales and price per unit of new textbooks. So this is easy, equilibrium, just make them equal to each other. So I can say 950,000 minus 20,000 P is equal to 150,000 plus 30,000 P. So if I take negative 20,000 to the right, it becomes positive 20,000. So that's 50,000 P equals, bring 150,000 to the left, it becomes 800,000. So P is going to be 800,000 divided by 50,000, which will give me 16. And for the quantity, you can plug it back into either equation. Gives me 630,000. That's your 2 answers for part A. That's nice, easy marks. The monthly sales is the quantity, and the price is the P. Now in part B, it says the government decides to place a $6 tax per textbook. If the government pursued this policy, what would be the new equilibrium price and quantity, and what percent of the tax would the supplier carry? Okay, so for this, you always want to draw out a graph. With all the supply and demand, always draw out a graph. It helps you see it. So we did a multiple choice earlier on subsidy. Now this is a tax question. But remember, in tax and subsidy, that's the only time you have to rearrange the equation and write it as P equals something Q. If you prefer doing as Q equals P and you know the other steps, there's a way you can find it like that too. But in the crash course and weeklies, we made it P equals. So I'll keep it the same steps to stay consistent. So on the demand equation, it's QD equals 950,000 minus 20,000 P. So if I want to rearrange that and make P the subject, how could I do that? That's your QD equation. So I'm going to bring the negative 20,000 P to the left and bring QD to the right. So it's going to become positive 20,000 P equals 950,000 minus Q. And then for P, you're going to divide everything by 20,000. So if you do 950,000 divided by 20,000, that gives you 47.5. Minus, now here you're going to get not a nice number. If you do Q divided by 20,000, that's the same thing as saying 1 Q over 20,000. So if you do 1 divided by 20,000, that's going to give you 0.00005. If you get like 5 times 10 to the negative 5 on your calculator, just do plus 1. And then it converts it. It's 1.000, 4 zeros and a 5. And that's Q. Okay, and I got that by doing 1 over 20,000. That's the same thing as saying 1 over 20,000 Q, which is 0.0005. That's your demand equation. And then do the same thing for supply. So the supply equation was QS equals 150,000 plus 30,000 P. That's your QS. So I'm going to bring 150,000 to the other side. So I'm going to keep the 30,000 P positive and say it's equal to Q minus 150,000. And then to get P, I'm going to divide everything by 30,000. So 150,000 divided by 30,000 is 5. And Q divided by 30,000 is the same thing as saying 1 Q over 30,000. So if you do 1 divided by 30,000, that's going to give you not a nice number again. It's going to be 0.000, 4 zeros, and then 333 reoccurring. Now, you've gotten your supply equation and demand in the form of P equals something Q. Now you can follow your 3 steps. So step number 1 is you're going to add the tax onto supply or subtract. Well, before that, let me just draw the graph. So for demand, it's going to look like this. The demand is starting here at a vertical intercept of 47.5. Whatever was your vertical intercept here, your P, that's your vertical intercept here, like Y equals mx plus b. But on supply, the vertical intercept now is actually coming out to be negative 5. So normally the supply is supposed to be like this if it was starting at 5. But if it's starting at negative 5, that means it's starting down here at minus 5. And can you ever have a negative price? No. So then the supply, you don't draw it like that. You could just draw it like this. In this case, it doesn't even matter because you don't need those intercepts to answer the question. So now let's go to the steps. Step number 1, in a tax, you always add it on. Remember we said subtract subsidy, but tax you add it on. Why? Because in a tax, the government is taking money from the business or giving money to the business. They're taking money from the business, like in cigarettes. So that's going to allow the business to supply more or less. They're going to be supplying less. So it's like the supply is shifting upwards. And I don't need to draw it all the way, actually. Let me just draw it till here to keep the graph clean. The supply is shifting upwards like this. If you made it go all the way through, that's fine as well. So now the supply is shifting upwards by $6 because they said there's a $6 tax. So the new supply curve is going to be the supply that you just got. So it's 0.0000, 4 zeros and then 3 reoccurring. Q minus 5 plus 6. You're adding the $6 tax on. So this is a 5. So negative 5 plus 1 is going to become 0.0003 reoccurring Q plus 1. That is the equation of your new supply. Now it's the same as the subsidy question that we did in the multiple choice. So step 2, you're going to make the new supply equal to demand. So this equation equals to demand, which was 47.5 minus 0.0005 Q. Now I can rub all of this off. So if I take this negative 0.005 Q to the left and bring 1 to the right, on the right you get 47.5 minus 1, which is 46.5. And on the left you're going to get 0.0333 plus 0.00004 zeros and a 5. Be careful with the zeros. So it's going to give you 0.00083 reoccurring Q on the left. And then to get the Q, you're going to do 46.5 divided by answer. That gives us 558,000. So if you keep all the 3's in your calculator and then just do like 46.5 divided by answer, it'll give you a nice round number. So that means that's the quantity over here is 558,000. And does that make sense on the graph? Well, what was the old equilibrium quantity? The old equilibrium was 630,000. So yeah, it makes sense. The quantity went down. So this 630,000 is right here. The old equilibrium. So if you're drawing the graph out, it helps you to catch any mistakes. So we got the new equilibrium quantity. Now we need to get the new equilibrium price. The new equilibrium price is where the new supply hits the demand. So you can plug it back into either of the two equations you just made equal to each other. Either the new supply or the demand, not the old supply, not the original supply that we had. So I'll just plug it in demand. So in the demand curve, it was P equals 47.5 minus point, and then 4 zeros and a 5, and then the Q you plug in as 558,000. So again, I'll keep the answer in my calculator times 4 zeros and a 5, and then do 47.5 minus answer. It gives me 19.6. That's your price, that's your quantity. So the new equilibrium price means the price to the consumer, which is up here, is 19.6. Remember, in a tax, the higher price is what the consumer pays. Like for cigarettes, consumer pays more. And what if they'd ask you what price does the producer receive? Well, you take this quantity and see where does that go and hit the original supply curve over here. So you always take the new quantity and see where does it hit demand? That's the consumer. Where does it hit the original supply? That's the producer. And how's that possible? If I'm paying this much, how can the producer be receiving this much? Where's the remaining amount going? That's the tax. So if it's $6 tax in this case, so this is for the consumer. So you could say the price for the producer would be this minus 6. So that must be 13.6. That would be down here. At the store, I pay 19.6. The consumer pays 19.6 for the book. The producer keeps only 13.6 in their pocket, and the remaining $6 they give to the government at the end of the month or at the end of the year as tax. So, do those two numbers make sense? Well, compared to the original equilibrium price, the original equilibrium price was here at $16. So yeah, it makes sense. One number is above, one number is below. What mistake do a lot of students do is they say, oh, there's a $6 tax, so they just add it on to the equilibrium price. They just do 16 plus 6 is 22. That's the new equilibrium. No, you cannot do that. If it was that easy, we wouldn't be doing all these steps. You have to follow steps. You have to add it on to supply, then find the new equilibrium, because part of the tax is being paid by the consumer and part is being paid by the producer. So if now I put the original equilibrium price there that we got of 16, how much of this tax is being paid by the consumer? If you take the difference here, the consumer used to be paying 16. Now they're paying 19.6. So that means the consumer is paying 3.6 more than before. And how much is being paid by the producer? You take the difference from here, from 16 to 3.6. They used to be getting 16. Now the producer is only keeping 13.6 in their pocket. So that would be 2.4. And if you took these two numbers, 3.6 plus 2.4, that would add up to the total $6 tax. So that means out of the 6, 3.6 is being paid by the consumer, 2.4 is being paid by the producer. So that will help you answer this part of the question. What percentage of the tax would the supplier carry? Meaning, would the supplier pay? So you could say the producer pays, out of the $6 tax, the producer is paying 2.4. They're receiving 2.4 less. That's the percentage. And this would give you 0.4, which means 40%. So you could say 0.4, or they ask for it as a percentage, right? Yeah, so for the percentage, times it by 100. So that means 40% of the tax is being paid by producers. And if they'd ask you consumers, that means consumers are paying 60%. They didn't ask for that, that's just a side note. 60%, I'm just doing 1 minus 0.4. So in this case, who's paying more of the tax? The consumer or the producer? The consumer is paying more. That must mean what? the demand is more elastic or inelastic? If the consumer is paying more of the tax, that means the demand must be more inelastic. Whenever consumers pay more, remember it's the more inelastic that pays more tax. Demand is more inelastic than supply in this case. Why? Because remember in the crash course and weeklies I told you that like when the government taxes the cigarette company, they take the tax from the company. But the company passes along the tax to the consumer in the form of a higher price. So if the company says, hey, I know these people are addicted, they're going to pass along a lot of the tax to consumers. So that's why in cigarettes, demand is inelastic. So in cigarettes, consumers pay more of the tax. But if it was something where demand was more elastic, like for Pepsi or Sprite or orange juice, then in that case, if they try to pass along the tax to us, we're just going to switch to something else instead. So in that case, the producer has to absorb more of the tax. Because then when demand is elastic, that means the consumer is really sensitive. So they're not willing to pay the tax. They're going to lose all their customers if they try to increase the price to the consumer too much. So that should help you answer. So we answered everything for part B. Government decides if the government pursues this policy, what would be the new equilibrium price? That was 19.6. What is the new quantity? That's 558,000. And what percent of the tax would the supplier carry? That was 40%. These are the three answers. This was just side note if they asked you what price does the producer receive. And this was only if they asked you how much does the consumer pay out of the tax. Now part C, it says define the same price elasticity of demand. The same price elasticity of demand just means the price elasticity. So it just means because there's cross price elasticity when you're crossing two different products like Coke and Pepsi substitutes or like complements like gas and cars. That's called cross. But same price elasticity means you're just looking at one product. So it's just price elasticity. If you ever see a word that you don't recognize, read the rest of the question. Often it doesn't even affect your answer. So it doesn't even matter. It's just price elasticity. If textbooks are compulsory for most students enrolled in university classes, how would you describe or characterize the elasticity of demand? So would you say it's more elastic or inelastic? If it's compulsory for most students, they have to buy the textbook. That means the demand is inelastic. Because that means even if the price goes up, the consumers are going to have to buy the textbook for their class. Some students might not, but most students do, because they said most students enrolled, it's compulsory. If most students follow their university requirements and purchase a textbook, would the tax lead to a relatively small or large deadweight loss or a drop in economic surplus? Deadweight loss is the drop in economic or the fall in economic surplus. Economic surplus is like the consumer surplus, producer surplus, government revenue. So when there's a big deadweight loss, that means there's a big loss to consumers and producers. So if demand is inelastic, would the quantity fall by a little bit or by a lot here? It would fall by a relatively small amount. So the deadweight loss is this triangle here. So you would say, since the quantity only falls by a little bit, before I answer, I can also just show you on the graph. Let me exaggerate it a little bit. I mean, you could draw it too to kind of make sure you get the marks. But if demand is really inelastic, that means it's really steep. Remember, it looks like an I for inelastic. So when demand is really inelastic, and the supply too, if the supply is really inelastic as well, well, then here you see the quantity will not change much because they're both really steep. So now when let's say you have this equilibrium quantity, which was whatever, 630,000. Let's say it was just like 100 to keep it simple. Now when we bring in a tax like this, you see the gap here is still like $6. It's still a $6 tax, but now you see the quantity is only falling by a little bit from, let's say, 100 to 99. So in this case, do you think you would have a big deadweight loss or small deadweight loss? You would have a relatively small deadweight loss. Now, if I made the demand and supply really elastic, like you could make a normal supply curve, but I'm just showing you both to exaggerate. So supply was elastic and demand was really elastic. And again, let's say your quantity was starting over here at 100. And now let's say I make the same gap the gap is the tax, right? So here, let's say it was a $6 tax, the gap. So now here as well, I want the same gap, $6. But if I do that, like that would be like from here to here. Because you see over here, the gap is smaller than 6, So if I want to have the same gap, it has to be around here. So now you see the quantity is falling by a lot. To make that gap $6, it would fall all the way from, let's say, 100 to 20. So there's going to be a lot of consumers and a lot of producers that are unhappy because the quantity is falling by a lot. So now you're going to have a relatively big deadweight loss. That's just for you guys to see where I'm going with the answer. Now you could put that in words. You could say there will be relatively small deadweight loss or small drop in economic surplus because quantity will only fall by a little bit when demand is inelastic. It means it's insensitive, so quantity doesn't change much. So it will only fall by a little or by a small amount, we can say. So the more inelastic, the smaller the deadweight loss because quantity is only decreasing by a bit. If it's more elastic, that means the quantity, everybody's going to stop buying the Pepsi or the Coke, and then there's going to be a big deadweight loss, big loss to consumers and producers. And that should be enough to get the marks. If most students follow the university, would the tax lead to a relatively small or large? Yeah, it would lead to a relatively small because that means the consumers are still going to buy the textbook. And so the government will make more tax revenue. So even the consumers will be unhappy and producers will be unhappy, but the government is making a big chunk in tax revenue and the quantity is only falling by a little bit. So there's only going to be a few consumers and a few producers that are losing out. Question number 3, last one. It says, it's December 31st, 2023. Billy has just graduated from university and found a new job that will pay him $65,000 in 2024. At present, he owes $40,000 on his school loans, financed at a rate of 9% APR, compounded and payable monthly. So what does that mean, compounded and payable monthly? Well, the compounding means that's the M is monthly 12. And payable monthly means the F is also 12. F means the frequency of the payment. So if you're paying monthly, you're paying 12 times a year. They are scheduled to be fully repaid in exactly 8 years. Billy currently pays $1,200 a month for his rent and he expects this will remain unchanged. He spends $800 per month in transit, health, entertainment, all of that. He has collected the following information about the tax brackets. So this is like personal finance, because there's some tax stuff mixed with time value of money as well, because there's some interest rates, APR, and it says in part A, compute Billy's monthly school loan expense. Let's start with that first. So what's his monthly school loan expense? If he at present owes $40,000, what is that? That's his PV, FV, N payment. That's what he owes presently. So that's his present value. So I'm going to put PV in my financial calculator is negative 40,000. Remember, always put the PV as a negative. What is the N? Well, it says he's making monthly payments and they're to be fully repaid in exactly 8 years. So the N is going to be 8 times 12. 8 years times 12 months per year. That's going to be 80 plus 16. That's 96. What is the IY? It says 9% APR compounded monthly. So to find the effective monthly rate here, I have to do EMR, which is 1 plus the APR. So that was 9%, right? So 1 plus 0.09 divided by 12 divided by M to the power of M over F. So the M is 12 and the F is also 12 because it's monthly payments. So it's basically just 9% divided by 12. Because it's going to be to the power of 1. And that's going to give me 0.0075. If you times that by 100, that's 0.75%. Because remember here, you have to put as a percentage in your financial calculator. And what is the FV? 0. There's no future value. We're going to compute payment. What is the monthly payment here? So we put it in our financial calculator. So 40,000 negative is my PV. 96 is N. 0.75 is my IY. 0 FV. Compute payment. I get 586.01. That's your answer to part 1. Part 2. It says his average tax rate. So what is going to be his average tax rate? Well, you have to calculate how much is he going to be paying in total taxes divided by his income, which is not 40,000 but 65,000, right? That's what he's expecting to make next year. So the average tax rate, we would find the total amount, so 65,000. We're going to take the first, so I can say total taxes is equal to the first 51,780 that he makes is going to get taxed at 13.26%. So you times it by 0.1326. That's the first bracket here. Oh no, it's not 13 that's the capital gains tax. You have to times it by the Quebec federal and Quebec tax bracket, not the capital gains. Capital gains is just if you have some investments, so that number is wrong. I'm going to put 0.2653. Plus the next amount that he makes is in this range from 55,000 to 51,780. So I could say plus 55,867 minus 51,780, that gap, times 0.3153. That's the second bracket. Plus, now how much is he left with that he has to pay tax on? Well, if his total income is 65,000 and he's already paid up to 55,867 at the upper end of the second bracket, you take the difference, 65,000 minus 55,876, 867, I mean, times the third bracket, which is 36.12. That will give me a total of 18,324.70. That's what he's going to pay in total taxes. Now I'm going to take that number and divide it by what? His income of 65,000. So I do 18,324.7 divided by 65,000, his income. So I'll just keep the answer in my calculator, divided by 65,000. It gives me 0.2819, which is 28.19%. That is your answer to part 2. Part 3, it says his after-tax expected monthly income. So what is his monthly income? Well, you do 65,000 divided by 12. Or you can take his total income and then divide it by 12. So his after-tax income in a year. So I can say yearly after-tax income is 65,000 minus the amount he pays in taxes, which is 18,324.7. So that means his after-tax income is 46,000 675.3. Now you can take this number and divide it by 12, because to find it per month. That would be 3889.61. That's the answer to part 3. That's his monthly after-tax income. Part B, it says many financial planners suggest that you should spend no more than 30% of your pre-tax gross income. Pre-tax. Would you say Billy is doing well to meet this guideline? Well, what is his pre-tax gross income? It is $65,000. So pre-tax, how much is his monthly income? You would take the $65,000 divided by 12 to get his monthly income before tax, which is 5416.666 reoccurring. That's his income. And how much is he spending on rent, on living income, on housing, they said. Currently he pays $1,200 per month for his rent. So if you take $1,200 and divide it by this number, 5416.6 reoccurring, I'll just do 1200 divided by answer to avoid any rounding. That gives me 0.2215, meaning 22.15%. So is he spending more than 30% on housing? No, they said no more than 30%, so he's doing well. So you could say Billy is doing well because he is spending less than 30% on housing. Or you could say that 30% of his pre-tax income on housing. So you have to divide it by 12 to get the monthly. Because remember, the $65,000 is annual, but the rent, $1,200, they gave you monthly. So you have to convert it to the same time unit, always. Part C, it says calculate the value of Billy's savings at the end of 1 year if after taxes and expenses, utilities, rent, all of that, his savings are earning 6% EAR invested in ETF. Would you advise him to use a TFSA or RSP account? Okay. So the first thing is, how much is he going to be saving? Well, go back to your previous answer. In part 3 here, we found what was his after-tax income. Once he paid off his taxes, this was per year, and then you divided by 12, this was monthly. So monthly, his income is $3889.61 after tax. Out of this, per month, how much does he have to pay in rent and utilities? The rent is $1,200 per month, and the utilities, transit, entertainment, all of that miscellaneous is $800. So that's minus $1,200 minus $800. And is that all? Or is there something I'm missing here? There's one more thing we have to minus out. What else does he have to pay every month? Don't forget, he has a student loan. What was his monthly payment on his student loan? We found that in part A. In part 1, the payment on his loan was this number, 586.01. So I have to minus that out as well. And now this covers all of his payments. 586.01, right? Yeah. So now we can calculate what is his savings per month. That would be 1303.6. So now what is this? Is this a recurring payment? Is this a lump sum? This is going to be his payment, because this is basically his monthly savings after taxes, after rent, after everything. After his loan payments, this is what he's left with at the end of the month. That's what he's saving each month. And they want to know how much does he have at the end of 1 year. So that means, what am I going to put as the N? N is 12, because he's saving the money monthly. So I want to know at the end of 12 months, by the end of the year, how much he's going to have. What am I going to put as the IY? Well, here they gave us 6% is the effective annual rate. But he's making payments monthly, so I want to convert that to an effective monthly rate. How can I find the effective monthly rate? It's not 1 plus APR because they gave us the effective rate, so you have to do effective to effective formula. Effective to effective means it's 1 plus K to the power of old F over new F minus 1. So in this case, the old, first of all, it's 1 plus 0.06 because 6%. Old F, it's effective annual, so that means it's 1 payment per year, effective annual. Over the new F, I want to find monthly, so that's 12, and then minus 1. Remember to use brackets to the power of 1 over 12, then close brackets. Minus 1, this gives me 0.004867 let's say. So if you times that by 100, that's going to give you 0.48676%. That's his effective monthly rate. Because they said effective annual, they didn't say APR, they said EAR. That's why you have to use this formula. So we have payment NIY. Now you're going to do PV is 0 because he's not starting with any money at the start of the year. And we want to compute FV because we want to know how much does he have at the end of the year. So I can say 1303.6 is the payment, 12 is the N, 0.48676 is the IY, 0 PV, compute FV. We get 16,068.87. That's how much she's going to have. That's your answer at the end of the year, at the end of 12 months, if he saves that much each month. And earn 6% annual rate, meaning 0.48% effective monthly rate. And also for the second part, they say, should he use a TFSA or RSP? Now, for this one, you could go with either route. They would give you the marks no matter which one you pick, as long as you gave good reasoning. So, probably it would be more logical to go with an RSP, because remember what's the benefit of an RSP? Is that can you reduce it from your taxable income for the year? Yeah, so you have to pay less income tax in that year. So you could say, use RSP. Because he can reduce it from his taxable income. And that should be enough to get you the marks. And you could say that unless he thinks that he's going to be paying higher taxes when he withdraws later on. Or you could have gone with TFSA as well. They accept that too. If you said like TFSA because it gives him more flexibility. Don't put both of these answers. I'm just giving you the two options. You could also say because it gives him more flexibility to withdraw. From the account without any tax considerations. That will give you the marks as well, as long as you explain the benefit of each one. Don't put both, just put one or the other. So, for example, with a TFSA, you don't have any penalties for withdrawing from it like you do in an RSP. And also you don't have to worry about what kind of tax bracket you're going to be in later on, because in an RSP you have to think, okay, if I have to pay tax on this at my current income, well, if I withdraw next year or in 2 years, would I be making less income then and pay less tax then? Should I wait? In TFSA, you don't have to worry about those tax considerations. You have more flexibility. So either way works, but RSP generally makes more sense when you're working because you can reduce it from your taxable income. So that's probably a slightly better answer. I would go with that one. Doesn't make a huge difference. Again, they're very flexible. As long as you're using your general logic and material from the notes, you should be fine. And that's pretty much it from this mock. So, like we said, one long answer on personal finance, one long answer on supply and demand, one long answer on NPV. That's usually the hardest one, is this one on either net present value or discounted cash flow. So I would actually start with the other two long answers first. Do the supply and demand, whether it's tax, price ceiling, elasticity. Then do the personal finance one on RSPs, TFSAs, savings, taxes, average tax, marginal tax. We did multiple choice on those also. And then go to the NPV one. And again, don't leave anything blank. Usually on that one, students freak out and they just leave it blank. Just put in anything. If you're not sure what's the effective rate or whatever, is it monthly or quarterly, just make up a number and then use that number for the later steps. You'll still get part mark for the later steps. If you get stuck, make up numbers, or just, even if you can just do the first half of the question, that's fine. Just get something down. That'll get you part marks. That's all about the part marks here for the long answer. And for the multiple choice, it's kind of touches on everything. So I'll be doing another mock. If you guys have any questions, you know how to reach me. If it's your first time taking a session with me, you can hit me up on Instagram at Ramiz Knows. Give me a follow there. You can ask all your questions. Or if you don't have Instagram, you can shoot me an email at ramiz@wiseprep.com. So in each mock, it's not like one mock is better than the other. They're all questions taken very similar from recent semesters' finals. So they're all good representations of what you should be expecting. And as we go through each question, like I did here, I try to brainstorm what else they could ask you. Like here, if instead of tax they said subsidy, you would subtract or you would add, and so on. All right. Happy studying. Good luck. And maybe I'll see you guys at the next mock. Ciao.